Hey folks, I wanted to record this quick little intro here since our recording with David Thompson on the topic of collateral assignment as used by real estate investors had a recording issue a few days ago when David and I had that conversation. So I wanted to make sure you had a clean intro as to exactly what to expect. This video is going to be really useful for real estate investors and anyone who is looking to use more creative strategies to get better funding access for your deals and your operations. So pretty fascinating conversation with David Thompson. He is a friend and colleague of mine. His office is located in Frisco, and David serves the state of Texas and several other states for life insurance and financial advising. David is a highly trained professional. I found him to be extremely competent. I think you'll enjoy this conversation. So stick around. We're going to jump right into the recording from a few days ago, and feel free to comment below if there's anything that we can help you with on this topic. Thanks so much.
Three things I heard in there was introduction time, and then tell people what I do. So David Thompson, Primary Purpose Financial Group. Again, to his point, we work with real estate investors, medical professionals, contractors. Our primary purpose and our slogan is we help people accumulate more wealth than they consume. Been in the business 6 years, had the business, all the glory to God. I take credit for nothing. He speaks through me. So second thing I heard in there was about 30 minutes. I have a feeling that it's probably going to be much shorter than that because talking about real estate and collateral assignments using life insurance isn't sexy. James and I were talking about this a little earlier. Like, I wished I did something that was a little sexier, but it's just not when it comes to collateral assignment. So I think it'll be a little more condensed, especially with a lot of the unrest in the country and everything, which maybe is why a lot of people didn't show up, James. So anyhow, let's jump right into it. A collateral assignment, essentially, you're using life insurance as collateral for a loan. So obviously it's going to lower the risk for the borrower. And the way that we do it, you can use any type of life insurance to do it. You can use term life, whole life, universal life, but to really pump it up, we use cash value life insurance. And what we do is we take a small amount of life insurance and we stuff as much cash inside of it as the government will let us without causing a taxable event. Then you have this collateral inside, you have this investment inside of the life insurance. And when you go to apply for a loan at the bank for your $1 million, $2 million property, you can put the life insurance up as collateral, two components to it, the cash values and or the death benefit. So it works out really, really well for two reasons. One, nobody ever goes out and buys a real estate property in hopes that it doesn't work out, right? That I can't rent this out or I get burned on my flip and my contractor's high and dry me. That's never the hope. But we know that things happen, right? Life has a funny way of changing. So a lot of people don't want to go and put their actual hard assets, their money, their other building, their other properties. Obviously, lenders will typically only loan you money on something that they want. So a lot of people will loan out money on real estate property and others won't. They'll only rent out or loan out money for oil, etc. So people don't want to go and put down all of their hard cash because what happens is then your cash isn't growing. You've obviously lost the collateral. The very interesting thing about collateral assignments is while you've got money inside the cash value life insurance, it continues to grow. So it is growing. You've put it up as collateral. You're not losing any interest. You're not losing any opportunity cost. And if you understand the ins and outs of cash value life insurance, you understand the tax privileges. It is the only thing in our internal revenue code that has the same tax treatment as a Roth IRA. So tax deferred growth, tax exempt distributions, provided that you use it properly. So these are really the big components, is stuffing tons of cash in it, paying the minimal amount for the cost of insurance. It is an insurance product, no surprise. There is going to be a cost of insurance. But if you can stuff $1 million in this and have $900,000 of cash values and a paid up life insurance policy, it works out really, really well in the eyes of the lender.
So when a typical investor is looking for funding, you either have, personal capital, or you're going to go out and look for conventional financing at a bank or a lending institution, or you're going to engage with one of the, literally hundreds of hard money or similar lenders that will have, origination points, and then, they'll have some kind of a rate for the term. Or if you're lucky enough to have someone in your network that has private capital, similar terms, but also potentially a lot more favorable terms depending on the capital and what you're intending to do with it. So what you're saying is something that a lot of investors should also consider as an alternative or an additional strategy to get more funding, or perhaps more stable funding that doesn't have a whole lot of junk fees thrown into it. Depending on what hard money lender you're using, there may be a whole lot of throwaway fees where you're not really getting any value for it. If I understand you correctly, there is, let's say, for instance, one of your best products is that custom whole life policy from New York Life, right? That's one of the heavy hitters that you have in your rotation, right?
It is, yeah. Most of the dividend participating mutually held companies have great cash values, right? Again, on some of them, you can get leverage about 90 cents to every dollar cash values in year number one. That's pretty exceptional.
Awesome.
Most people who buy permanent life insurance, they put $1,000 in premiums, they have $0 in cash value. So those are the ones that we typically leverage the best. Yep.
So what does it look like? You go and decide, if you're, let's say I'm a real estate investor, and I call you up and say, hey, I heard about this collateral assignment thing. So the process, just so I understand, just so our viewers understand, you would contact someone like yourself who can help set up a life insurance program with the intent on the front end of using it for collateral assignment. So we go to David Thompson, Primary Purpose Financial Group, go and purchase a cash value life policy and overfund that thing all the way up to the limit the government allows us to. It's MEC, right? It's a modified endowment contract, which in like layman's terms just means a taxable event. MEC is no good. We don't want the MEC. Right. And then they would take that cash value and then assign that to a lending institution as collateral, thereby pumping up the available line of credit or a loan. Is that basically the whole strategy?
That's exactly right. So two things, collateral assignment can be done, yes, James, with a brand new policy. I've never had life insurance. I want life insurance. I want to go see David or my guy over there and get one and do collateral assignment. And in addition to that, if I've got a cash value life insurance policy and I've never used it as collateral assignment, you can collateral assignment that as well. A collateral assignment, and I'll break it down. I don't tell many people this because it makes us look super smart, and we're not. A collateral assignment is really just a piece of paper you put on top of a life insurance contract. James Jenkins is going to go and get $1 million cash value life insurance policy. His wife is going to be the beneficiary. $1 million, he dies, wife gets $1 million. But he's going to take out a $500,000 loan on a little business strip over here. So he's going to put that collateral assignment, that piece of paper, on top of that life insurance policy, saying the first $500,000 in the event that he dies, the bank gets paid first, whatever's left goes to the wife. So two things. Yes, you can start with a brand new policy, use it as a collateral assignment. Second thing is, if you currently have cash value life insurance, you can put a collateral assignment contract on top of it. Okay. So that's the first thing. Second thing is, yes, obviously it lowers the risk for the borrower, giving you lower interest, giving them guarantees that they're going to get paid in the event that you default on the loan and or if you have a premature death. So it's very, very strong for our lenders, getting down low points, and very, very strong for our borrowers who are looking to really leverage their dollars. Yep.
So one of the most common questions I get from our investors when we talk about this, and full disclosure, I don't do life insurance at my office anymore. Back in the day when I was a full service, AKA generalist, do everything at a moderately okay level instead of doing a very small number of things at an extremely high level, which is my business philosophy now. I used to sell life insurance at my farmer's insurance agency, and one of the products that we had was not nearly as appropriate for the strategy as a fixed rate on a custom whole life. We had a variable product where the potential rate of return went up and down with the stock market. In that case, it was tied to the S&P 500. As a product category, it was literally all over the map, which makes it not very attractive for collateral assignment because you could just soak up all of your cash value and suddenly your collateral is worth less than it was a year ago. So I'm guessing you're going to say that that kind of life insurance that is in some way tied to an investment product is perhaps not as attractive for this particular strategy, right?
You took the words out of my mouth. Now, each lending institution is going to have certain criteria. To answer your question, most of them will allow you to use a universal life. A universal life is the chassis. And what it is it's a yearly renewable term. Other words said, forever increasing term. Every year it has a term policy inside of it, and the premiums get higher and higher. But your cash flow out of pocket stays the same. Well, what's making up the difference of that premium getting higher every year? There's a component inside of all universal lives, the cash value. There's three things that fund it. The market, like you talked about, which is variable universal life, an indexed account, which is tied to an interest-bearing market riding account, other words known as indexed universal, or a straight interest-bearing account. So I've got a bucket of money that's growing, and every year that money grows, a certain portion comes out to pay that forever increasing term. And whatever's left is what gets those market or the interest rate participations. Most banks don't like to use those simply because there is no guarantees. The only guarantee you have in universal life is it's guaranteed that cost of insurance is going to rise every year. Plain and simple. Yeah. Plain and simple, guys. And I write all the insurance. I'm telling you, the only thing that's guaranteed is every year your cost is going to go up. So with that being said, we look to use traditional permanent cash value whole life insurance because it has a guarantee your premiums can never increase, guaranteed your death benefit will never decrease, and guaranteed interest every rate. In addition to that, dividend participating, you get dividends every year provided that they declare a dividend. Most of these companies haven't skipped the dividend for 150 plus years. Pretty good chance you're going to get a dividend. Yep.
So one of the common questions we get with this particular strategy from investors is, okay, let's say I go and do this thing. I do the collateral assignment and I get myself a life policy. I'm ready to assign this collateral. What kind of multiple am I going to get if I put, say, $250,000 into a life insurance policy? You know, we get a couple of good deals, a couple of big wins on closing some property. We want to leverage this profit into, more funding. What kind of multiple are you seeing? A couple of years, and it's been a couple of years since I did one of these as the life insurance agent. It was, somewhere in that 3 to 5 multiple range, if it was a good piece of collateral underneath, where you're going to get somewhere in that 3x, maybe 4 or 5x, depending on the lender. Is that kind of the range of multiples you're seeing when your clients leverage this strategy, or is it a little bit less?
Usually what we're seeing is you've got to put about 20% collateral down. So in essence, you can get 4 to 5 times leverage. That's exactly right.
Sweet. So for the investors watching this and they want to consider collateral assignment as a funding strategy for their deals, using the 20% rule is a fair number?
Yep, absolutely.
So if they're looking to get, say, $1 million in line of credit to go out and buy properties, they need to be ready to put down somewhere in the neighborhood of $200,000 of cash into that policy, which I'm guessing that's just a conversation with a financial advisor like you to determine how to structure the policy for optimal cash flow and output, death benefit versus overfunding on the cash. Is that about where you start that conversation?
You hit the nail right on the head. If you put $200,000 in cash values in a permanent life insurance policy, you'll immediately have $175,000, $190,000 worth of cash values contingent on who writes it, how they fund it. That's one component. That's the cash. The death benefit, however, is going to get you millions. Now, most people know as you do a collateral assignment, the bank is going to ask for 80% of the loan in death benefit. So in the event you don't come home, you got $2 million of death benefit. They're going to want 800,000 of it. You got 200,000 in cash. So you could probably leverage this particular life insurance contract for a couple different collateral assignment loans. But to answer your question in short, yes, in detailed, it depends is always the answer. Depends on how old you are, how healthy you are, how much money you put into it, how fast. So I don't want to make a blanket statements. Get with your financial advisor and make sure you work with somebody who's familiar with collateral assignments because not all carriers offer them. Just like when you deal with James Jenkins, he knows what forms have to be notarized, which ones don't, which ones take this long, which ones take that. We do these all of the time, folks. So there aren't going to be any surprises where we tried to run you through the XYZ company only to find out when you get approved for the insurance after your exam and the phone call and the fluids. Oh, by the way, they don't accept collateral assignments. So make sure you work with somebody who's reputable and ask them, have you done collateral assignments? I don't want you practicing on me, right? Let's make sure that we understand the process. Yes.
I mean, talk about a come on, man sort of moment.
Yeah.
You know, it's like walking on the lot at a Ford dealership trying to buy a brand new BMW. It's like, wait a second. This is that's not going to work. What are you doing? So you said it just a second ago. And my next question was all about the potholes, the drawbacks. Where are the landmines waiting to blow this thing up? Because I'm a risk manager, man. I'm always looking at the worst case scenario. And some of my clients get annoyed sometimes. It's like, yeah, but that's never happened to me. And I'm like, yeah, it only has to happen once. And then you're toast. You know, the whole it's never happened to me. Whatever. That's a different story. Sorry. So when it comes to this particular strategy, obviously, I think the first one we need to acknowledge is in order for this to be an option for you, you have to be able to, qualify for life insurance. So if you've had stage 4 cancer, if you've had multiple heart attacks, if you're morbidly obese and diabetic, this may not be the best strategy for you because, oh, by the way, you have to qualify for a life insurance policy. So that's probably the first one. As far as a drawback or a potential landmine that's waiting to blow this up. What are you seeing as other potential negatives, other problems that have to be overcome for this to be a great strategy for somebody?
Yeah. So to your point, the cost of insurance is always one of them, right? So if you are unhealthy or something happened, now you can put insurance on somebody you have an insurable interest in, family member, business partner, and you can own the policy outright. So I'm unhealthy. I can't get the policy. James and I are business owners. James, I need to put a life insurance policy on you. I'm going to own it. You're simply a pawn in the game, right? You're just the insured. And then you can take that as collateral, which I want to talk to you about this real quick. When you do collateral assignments, there's two kinds. There's absolute control, and then there's conditional control assignment. Absolute assignment, we see a lot of investors make them mistakes. So they go and they think that they're supposed to make the bank the beneficiary, and that is just not the case. So when you do that, what happens, same example, $1 million life insurance policy, $500,000 loan. If you make the bank your beneficiary, they get all of the money. And in addition to that, you give them complete control. So they now own the policy, they own the cash values, everything inside of it. So you don't ever want to do that. Okay, you don't want to ever give them absolute assignment. You always want to do conditional assignment, which is where James Jenkins owns the policy. James Jenkins controls the cash values. Sorry, guys, my phone's going off. And James Jenkins, if in the event that James Jenkins doesn't come home, his wife still gets the death benefit, everything after the loan is paid off. So that is one of the big pitfalls that we see. In addition to that, a lot of people will commingle this money. So they've got their one big policy that is legacy money and estate planning, and they'll put a collateral assignment on top of it. Now, obviously, that is going to hinder the death benefit, the money that is going to be left for your family. That is one of the big hiccups that we see with this. In addition to that is if something is to happen to one of these properties and you can't get rent out of it, or your tenants start trashing the place and you have to liquidate it, it can cause you to pull cash values out to pay off this loan. And sometimes it can cause taxable events, depending on how fast you pull the money out, how much money went into the contract. So those are really kind of the major potholes. And using the right type of insurance and making sure it's not in the market and you got to start taking out on a down year, that could obviously cause the whole policy to cannibalize itself. No cash values, you still owe money on the policy, and you no longer have the property. So that could be a very, very bad deal.
Wow. No, that's great advice there, man. Thank you. Just kind of in summary, it sounds like what I'm hearing you say is you want to stay away from a universal category of life, whether it's fixed universal or indexed universal or variable universal. They're all basically less than ideal solutions. I guess you could do a collateral assignment for a term policy, but there's no cash value. It's just death benefit. So I imagine that's probably not really an attractive option. If I'm a lender, I'm not really interested in collateral assignment from a policy that more than 98% of the time does not pay out before it expires. That's not really attractive to me. What I'm hearing you say is a cash value whole life policy with a fixed, reliable dividend is really the target product category. And in all fairness, I know there are lots of options out there. David is an independent life insurance broker. He represents plenty of companies. New York Life has, my personal life policy is with David and New York Life, but there's lots of other good options. Northwestern Mutual, Mass Mutual, and a bunch of other companies have quality whole life policies. So even if you're not working with David, it's a very good idea to get with your life insurance representative, your financial advisor, just to get equipped with information about the collateral assignment strategy. So obviously my personal preference is using someone like David who has a mountain of experience, but there you go. I have to put that disclaimer out there just in case someone thinks that this whole conversation is a steering activity.
That's a great point. And we always advise our clients, hey, ask them, and I don't give a rip what carrier you choose, because there's a ton of good ones out there. There's a few bad apples in the bunch too. Simply ask your advisor, why did you choose this company, right? Why did you choose this company? And then have another one queued up, right? Why did you choose Mass Mutual? Why didn't you choose New York Life? Or why didn't you choose Ohio National? Ask them. Make sure that they have the ability to write other carriers. And if they don't, if they can't at least shop you around or can give you some dividend history on it, you might want to find you another advisor for sure. Yeah,
well,
great.
I don't think there's anyone watching this video that has any doubt what my perspective is on working with an independent advisor, someone who's not beholden to a single company. Because at that
funny
point,
you say that, James. I just went back and watched that video when you handed down your old, and we'll leave the name out, like you said, for attorney purposes. I watched that video, that 5-minute video you did again when you started your brokerage, and it was awesome, man. It speaks as true today as it did 2 years ago when you printed it, man. I love it.
Yeah, no, it's every year I go back and look on March 1st. I dropped that video, March 1st of 19, and it's like, wow, so much has changed in the last 2 years. But hey, this is not about me. This is about our investor clients and prospective clients. We got two people on the call here, Ryan and Mark. Thank you guys for joining us. Ryan has been incognito the whole time. I hope he's actually here. Before we jump off, and I'll let David give us a wrap up of why Primary Purpose Financial Group is a great option for real estate investors to partner with, I wanted to open it up to you guys for some Q&A. Anything that you've pulled out of this conversation you wanted to talk about or get some clarity on with a question. Mark or Ryan, either one of you guys.
I got a question there. So depends on the policy. You don't have to keep funding the policy yearly. Is that correct? Because I know there's certain policies you have to keep putting capital in every year.
Great question, Mark. And it's one that I really wish people would ask more up front. I hate to do this to you. The answer is it depends. Okay. That 7-pay limit we talk about, the modified endowment contract, you never want to do that, because then we've blown the tax treatment. It now has the same tax treatment as your 401k or your SEP IRA. Now, one of the criteria to that is you can't stuff too much in it too fast. Example, we're going to put $100,000 a year in it. The fastest they'll let you put it in, Mark, is 5 years. Okay. So you can put $500,000 in this thing, but they're going to make you do it for 5 years. So here's the catch. We've got the life insurance contract. Well, you can't see it, of course, because of my black. We got the life insurance contract right here that we're going to put $500,000 and $100,000 a year. We've got your bank account right here that's going to fund it. Well, you see my head? That's the account in between, and we call that the PDA, Premium Deposit Account. So what we do is we take your $500,000 and we put it in the premium deposit account. What is cool about this? Well, it's paying about 3% interest right now. Okay. It's not tax-free because it's not in the life insurance contract. But we take your $500,000 here, and then every year, what does it do? $100,000, and then it spits you out the 3% interest. $100,000, it does that for 5 years. So the answer, and again, I hate to do this to you, is it depends. Yes and no. Yes, you can put it all in the premium deposit account in 1 year. But again, that is simply going to make 5 payments into the life insurance contract, because no, sir, you cannot put $500,000 in a life insurance policy in 1 year with the expectation to never have to fund it again without it necking. Great question.
Great. Thank you. And I'm assuming, one other question, I'm assuming if the beneficiary is a trust, that's not an issue.
Correct.
If it's a trust. Okay.
That's it. Yep, you got it. Because the beneficiary is the beneficiary. The collateral assignment is simply a piece of paper that sits. It tells the life insurance company, if Mark passes, you're going to pay out the ABC bank $30,000 before you pay his wife or the trust, et cetera. Yep.
Got it. And you have lenders that you guys work with that you can refer us to?
Absolutely, we do.
Excellent. Okay, cool.
Now, I can think of 2 or 3 off the top of my head that are sitting there with their hands out going, come on, come here, daddy.
Absolutely.
What kind of fees are involved from the lender's aspect of it?
Yeah, so that you'd have to get with the lender on. As far as is there a fee to do a collateral assignment? No, sir. Nope. Okay. It typically what happens is it's a courtesy that your financial advisor is going to do. No surprise here. Whoever writes your life insurance policy, he or she is going to get some type of commission. So they just kind of absorb that into the commission. Yeah. As far as what are interest rates doing, I mean, that's a conversation you got to have with your banker. As far as how much do we charge or does the bank charge for collateral assignment? The answer should be null and void. If your advisor, your bank tells you it costs anything, you're talking to the wrong advisor or bank. We do it as a courtesy.
Got it.
Yep.
One more question, if you don't mind. I'm sorry. If you currently have a life insurance policy in place currently now, right?
Yep.
So that one currently I could technically do the class collateral, or what's the process like if I want to take that and roll it over to like your firm or something?
Yeah, great question. So I heard 2 questions. If I want to use it, what do I got to do? Number 2, can we roll it? So let's address the first one. The answer is yes, you can use it. I would ask you a couple questions. Is it structured for cash value or is it structured for death benefit, right? And you'd have to look at the contract and figure that out. So if you say, David, I want to use it for collateral assignment, but unfortunately it's not structured for cash values. I mean, I put 90 grand in this, only got 20,000 bucks. Then to answer question number 2, yes, we can do a 1035 exchange where we take it out of that contract, we put it into a new contract, design that contract to where every dollar Mark's putting in it, 90 cents is going towards the cash values, not 90 cents is going towards the commission. And trust me, there's plenty of guys and gals out there that do it that way. We can 1035 it. What's the catch? I'm one of those guys. That's why James and I do business real well together. Anytime there's a good, there's always a bad. What's the catch, Mark? The catch is you got to go through underwriting again. No life insurance company is going to let you 1035 this contract over to this one without seeing if you're healthy still. So that there is a catch. Yes, you can do it, contingent on your health.
Thank you so much. You gave the good and bad on that one, so I appreciate that.
That's what we do here. You bet, brother, anytime.
And I'm assuming at the end, we're going to get your contact information?
Yep. No,
I'm sorry. That's a closely guarded secret.
I was going to say.
No phones or emails allowed here, sir. David, put your business card away. Dang it.
I wish I could get my email to start flashing on the screen right now.
The beautiful thing is when I bring this into Premiere later and pretty it up, I can make everything flash on the screen in front of you right now.
You should do that. Call the number above. Yeah.
Call now. Representatives are standing by.
That's awesome.
Oh, geez. Mark, those are good questions, my man. Ryan, I don't know if you're here. If there's anything you want to add, let me hit the chat real quick and see if Ryan said anything. Ryan has not. So before we wrap up, my man, Ryan, anything you wanted to add? Any questions you wanted to ask? If you're even there. That's always the challenge when someone's mic and video are off. You're like, is this person even here right now? Are they grabbing a sandwich? Are they in the bathroom? I guess not. Okay. But yeah, that's really it, man. I'm really grateful that you took time out to talk about this. As someone who no longer practices life insurance as a part of our business, I'm really not qualified to discuss this anymore from the side of things that you are. And, RiskWell made a very conscious decision that we do 2 or 3 things and we do them extremely well. We don't do life insurance or financial planning or disability or health insurance, employee benefits, supplemental accident, like the AFLAC type of policy. We do literally none of that. No long-term care, nothing. It is just property and casualty insurance, specifically for real estate investors in 3 categories of businesses. We'll do personal insurance, but it's only by referral or if you have some other piece of business with us. But we specifically do those 2 or 3 things and then partner with guys like David that do one or two things and do them at an extremely high level. I'm a very firm believer having a nice library of advisors who have a very specific lane that they stay in. They are a true specialist. That is a mountain of value rather than dealing with one party. And I won't name the company, but you can imagine what I'm talking about is the perfect example where, I do insurance and life insurance and auto loans and banking and financial advising and mortgages. I do all of them in one office. And I'm the best in class at all 17 things. Yeah. I mean, come on. I don't know about you, but as a savvy consumer, as someone who, I buy insurance just like everybody else. I don't want to work with someone who does 17 different things. I want to work with someone who does one or two things at an extremely high level. When it comes to collateral assignment, when it comes to working with real estate investors, David Thompson, Primary Purpose Financial Group, great option. David, as we wrap up here, why should an investor pick you over somebody else? What makes you and your firm a better fit than insert copy and paste advisor down the street?
Well, I don't know what I can say that hasn't already been said. And thank you very much for this opportunity, James. Quite simply, because we know how to do them, right? We know the questions to ask. We're not just going to slap something on you. We're going to make sure that you're doing this in your best interest. We've explored all other interests. I think we just saw an example with Mark and I. We're going to give you the good, and we're also going to give you the bad. Folks, the one thing that I know in life is there is no free lunch. If somebody's going to tell you, we've got this investment that gets you this rate of return and everything's guaranteed and tax benefits and no risk, it's just not true. Everything comes with a gotcha. David's going to explain the benefits. He's going to explain the gotcha, and we're not going to put you in something that doesn't make sense. And again, most importantly, we know how to do these. We know how to do these. We know the questions to ask. We know the carriers that write you, the carriers that will write it for you. And most importantly, we know the ones who will not. That's why.
Awesome. I love it. Simple and sweet. For those of you that want to get in touch with David for just a conversation, David primarily practices in the state of Texas only at this point, but I know he has people in other states. Are you somewhere else other than Texas now?
I'm my office is in Texas, but with virtual, I'm licensed in Florida's one of them, New York, New Jersey, Alabama. 15, 16 states.
My bad, dude. I didn't even know that. Here I am giving bad information. So forget what I just said. He's not just in Texas. He can handle whatever you need. God bless, man. It's hard to get good help, isn't it? Goodness.
It really is, James. We were just talking about this earlier today, weren't we?
Golly. Yeah, so 15, 16 states. In the description below, I'll put all of David's contact information. He's all over social media to the extent that the regulatory bodies will allow him to be. Thank you, FINRA. Thank you, SIPC. I'm so glad I don't have to deal with either of those bodies anymore, let me tell you. But yeah, that's really it, man. Mark, thank you for joining us. Ryan, if you're there, thank you for joining us. And for everybody watching later on our YouTube and other social, check it out below. And for everything else, you know where to find us. And that's really it, boys and girls. Thanks again for watching. And life is risky. Risk well. I'm going to turn off the recording and we're going to wrap this thing up. See you guys later.
Thanks, guys.